Hello ladies and gentlemen, thank you for tuning in to the Ascending Abundance YouTube channel. My name is Pavel. I'm a CFA and CPA, Certified Public Accountant, Chartered Financial Analyst, and on this channel I cover various strategies on how to make money with your money through stocks, crypto, real estate, business, any other ideas that can make us more money. I'm not an advisor. Any content on this channel should be just for information purposes. Do your own research, make your own decisions. But I do like to share my approach to evaluating companies. And previous videos on this channel that covered stocks got a lot of views. The videos that covered some real estate got way less views. Crypto got even less views, and then anything that I talk about, just conceptually my finances or my background, got almost no views. So I'm back to exploring various stocks because that seems to be of interest to most of you on this channel who are visiting. And I decided to look into just the biggest companies in the universe, or namely in the United States. So this is S&P 500, list of all of the holdings as of today. Today is June 11, 2023. The biggest one is Apple, and I might just do the analysis of the entire 500 one by one. I've got my own approach, but why don't we start with Apple being the biggest company out there? So all I did is went on Google, just said, hey, Apple Investor Relations. This page comes up. I click on SEC filings. Choose annual. For our example, this is enough. 10K annual report is what I'm going to be looking at. And using financial statements to understand what the company is about, how are they doing financially, are they expensive, what are their prospects, and everything in there is going to help us make a decision of whether Apple is a good stock to buy, hold, sell, and what are they up to these days. So I think everybody knows what Apple is. I'm not going to talk about their business plan or strategies, go straight into financial statements. Opening up 10K, PDF is my option. You can go Excel, you can do anything else. In PDF, go to the list of table of contents, financial statements, and we arrive somewhere blank, which is weird, but you can scroll to the left and look at their statement of operations. So this is what's known as income statement. And what I'm looking for is really their sales. Sometimes they call it revenue, depending on the company. And I'm looking at total, and I'm also interested in net income. Ultimately, all the other fluff is important. It's really valuable to know it, but at the same time, ultimately, all we're after is net income. How much money is this company making today? What's also useful is to know their number of shares, but I'm going to get to it a little bit later. So, if I were to look at it and move that into Excel, and here's the Excel that I've made for myself. Don't pay attention to the stuff in yellow. I am going to be literally just typing in these numbers from the income statement. So again, total net sales and net income here. These three and these three numbers. I'm going to type it in quickly and take a look at what is income statement tell us. So $394,328 in this year. Previous year was $365,817. The year before that was $274,515. Net income almost $100 million, $99,803. Previous year was $94,680, and previous to that was $57,411. Okay. What does that tell us? It tells us the profit margin as well as the growth in income. Again, ignore everything below it. So the profit margins are staying consistently high, 21, 26, 25%. So in the 20s, in the middle 20s, that's amazing for net income after taxes. So that's really good. And the growth, obviously, from 2020 to 21, because of the COVID, there was a huge jump in just an absolute dollar value. From 21 to 22, not as much, I guess, financially people were not comfortable buying new iPhones. I don't know what happened there, but we still grew, as in Apple still grew by 5%, but not hugely so. Okay, that's just a piece of the puzzle. Let's hide it for now. Look at the balance sheet. So in the balance sheet, go back to financial statements. In the balance sheet, here it is, consolidated balance sheet. What I'm looking for tangible assets. If you look at the total assets right here, they are comprised of not a half, but a good chunk from current assets. Those are your marketable securities, cash, accounts payable, accounts receivable, some inventories. Like all of this stuff is highly fluctuating. It is churning a lot. I don't like to look at it. I want to remove that from my assets. In the liabilities, same thing. 153 billion dollars of liabilities. So this isn't thousands, so that's millions. A lot of it is covered by assets. So yes, they have accounts payable, but then they have accounts receivable. Where is it? There you go. So all of this is just adding to noise, and it's churning, and it's inventories, and some like deferred revenue that is gonna come within a month. So I'd like to remove that. And I'm also on the lookout for goodwill. Is there any goodwill on the balance sheet? Because that's not a tangible asset. Anything happens with the company, it just goes out the door. Goodwill is not useful. So going back into my calculation, and maybe I should just put it side by side like this so you can see both. There you go. So looking at this calculation and looking at the numbers. So what I'm interested in for the last 2 years, total assets 352,755. Previous year, pretty much the same. Assets were kind of flat. I removed the liability, which is the same as almost same. It's a little bit bigger than the current assets this year, a little bit smaller last year. Again, just the noise. Just remove the current liabilities, get them out. 153,982, 125,481. There's no goodwill. No goodwill to remove. Let's double check. No goodwill in the assets, current or non-current, so that's wonderful. And then I just need to plug my equity, and total shareholders equity is right here at the bottom. So 5672 and 6309. So what does this tell me? Let's make it bigger. What does this tell me? It tells me that the tangible assets have actually decreased. There's no goodwill, that's a good thing. The net liabilities have also decreased, but not as much as the tangible assets. I see the equity is decreasing, and I see the debt to equity, which is the calculation I just put in Excel. Net kind of net equity without goodwill, it's zero, so it's very convenient. Equity is equity. Equity to net debt or net liabilities is nearly 3, and it's growing. So that's a little bit of a concern, but that's not the full story yet. The biggest and the most important piece of the puzzle is the cash flow statement. Again, ignore these calculations at the bottom. I'm gonna fill you out on what that is. So looking for the statement of cash flows. Here you go. That's the bigger statement of cash flows. That's when we see what the company made in terms of its cash. Because there are some non-cash charges on the balance sheet and the income statement, like depreciation. Depreciation is not a true expense. It is just an accounting term to see how much you're probably spending on your equipment. I want to know what the company is actually spending on its equipment, which is right here, payments for acquisition of property and equipment. Because without it, it cannot operate. If the company is spending all of its money on buying new equipment, and yet their sales are barely growing, then all the cash it generates just goes back into buying more equipment. What's the point of that? The company is just sort of self-funding itself. So I'd like to see how much they're paying for property, plant, and equipment. I'd like to see how much they're paying in dividends, because that's kind of an obligation they made, and I want to make sure that the cash generated by the company covers the dividend nicely. And that's really kind of my target for this cash flow statement. So looking at the last couple of years, there's 3 years available in this financial statement, so we'll utilize all 3. So let's just get plugging. First year, 151, 104, 038. Oh, 104, 038, and 8674. So you can clearly see the operating cash flow is growing really nicely. Capital expenditures, how much are they spending on property, plant, and equipment to make their sales happen? It's right here, payments for acquisition of property, plant and equipment. So fairly consistent in the last couple of years, 11,085 and 7,309. So last couple of years post-COVID, they've been spending just 10, 11 billion, million, whatever that is, probably billion. It's in millions, great. So 11-ish billion on capital expenditures. Meanwhile, they're generating 120 billion in cash flow. It's amazing. But maybe they're generating all this cash from acquisitions of other companies. So let's remove that as well. Payments for acquisition and property, no. Payments made in connection with business acquisitions, net. So are they buying competition and paying a ton of money for that? No, not really. They barely spend, any money comparably on acquiring other companies. So the cash remains. Well, maybe they're paying all of this cash in dividends and they don't retain anything for themselves, and therefore this company may go belly up or may cut its dividends. So in here, financial activities, payments for dividends and dividend equivalents right here, 14. Alright, so not that much. So 14,841, 14,467, and 14,081. That is growing, but it's been kind of consistent-ish. So what do we got left? Every year, this company, Apple, is generating tens of billions of cash on top of their expenses on property, plant, and equipment, on top of acquisitions, and after paying any dividends, they left with a ton of money. So how are they spending this money? Let's go back to the income statement. Let's go back to the income statement. That's when they showed shares used in computing earnings. So that's their shares outstanding. I usually use diluted because that's the shares after dividend, after all kinds of stock options and promises they made and so on. So look at 635,819. Let's look at this 16,864,919 and 17,528,214. So as you can see, the cash flow was spent on acquiring more and more shares from the market. They started 2 years ago at 17.5 billion, purchased hundreds of millions of shares, then purchased another 500 million shares. That's a huge decline. In percentage terms, if we look at it, they're buying back 3.8 and then an additional 3.2% of the company. So just over 2 years, Apple took out 7% of the outstanding shares. So obviously any kind of earnings, any kind of accretion of their business now is divided by a smaller number of shares, so every shareholder gets a little bit more of the company. And then let's look at their dividends. I had to pull that up from the internet again. They're paying 0.96 per share per quarter. So that's this year's dividend. Previously they've been paying 0.88, no, actually 0.92 per quarter, and prior to that there was plus 88 per quarter. Okay, great. So the dividend has been increasing at about 4.3%. So the dividend is increasing, share count is decreasing. I love it. The company has plenty of cash flow to cover all kinds of expenses as well as the dividends. They're repurchasing their shares, all fantastic, but are they expensive or are they cheap? So these financial statements are at the end of October. So looking at the price of Apple, just online, I kind of Googled it up. Price of Apple end of October was $138 in 2022. It was, let's see, about $149 in 2021, and it was way lower, something like 110-ish if I remember correctly. Yeah, it's roughly 110 in 2020. So is this expensive or is it cheap? What I do is I divide this price by the free cash flow per share. So let's walk through this. The free cash flow this company has is basically everything: operating expenses, operating income minus expenses minus acquisitions. That's kind of the free cash flow they generate. They spend some of it on dividend and the rest they retain. The number of shares, we know what it is, so free cash flow per share is just a straight formula. So it's $6.81 per share is their free cash flow after all of the expenses and the cash outlays. The price is 138, so that gives me a price divided by free cash flow that generated by Apple at 20.3. Let's make it a one decimal number. So how does this compare to last year? Well, last year we were at 27 free cash flow, and the year before that it was almost 27. So 20 compared to 27 and 27 actually looks inexpensive. Their dividend payout ratio is also really small, so their dividend is super safe. So all in all, what's not to like? You seem to be buying this company at a smaller ratio of price per free cash flow. Now, that could be a function of higher interest rates in the economy. This could be a function of recession that is probably coming. This could be a function of overall sell-off in the stock market. This could be a function of competition maybe creeping in, and those sales and revenue figures may no longer be growing as fast as they used to be. It could be anything. However, just looking at it from the overall perspective, Apple seems to be cheaper to purchase than it used to be in the last 2 years. And is that an amazing opportunity? Hard to say. It's probably not a steal of a deal. You're getting it cheaper on the relative terms, but the interest rate's gone up. So now everything's cheaper. The entire technology sector has been hammered by stock market. So is this a steal of a deal? Probably not. Would I say this is kind of overpriced? Probably not. It seems to be kind of hanging in there. The sales are not growing as fast. The shares are being repurchased, but not a phenomenal rate. The dividends are growing, but again, not a phenomenal rate. The ratio of 20 times free cash flow is low-ish historically, but it's not cheap. It's certainly not single digits. So is Apple overpriced, underpriced? I would say it's kind of in the zone of fair pricing. If I look and compare it, for example, last year I did the analysis for ADP. ADP is another company in the United States. They do payroll. So if you look at price per cash flow, just for comparison, it fluctuates widely. 10 years ago it was 14 and 15. In 2020 and 21 it was 40, 31 and 40, which is bigger than Apple. So is ADP a better company than Apple? Is it growing at a faster rate? Well, doesn't look like it. It was growing at the same 5% in 2021. So on a relative basis, I could conclude that ADP in 2021 was probably somewhat overpriced, whereas Apple in this year, 2022, is looking like fairly priced. Or maybe you could even make a claim that this is underpriced a little bit. Now looking at their charts and doing some technical analysis and comparing this to other stocks, or maybe buying it through an ETF like S&P 500 instead of getting exposure to just one company, those are different options that you could only decide for yourself. As for me, I find this analysis kind of curious. I could probably put some sort of ranges in here if I extend this analysis over 7 to 10 years and see what kind of price to cash flow ratios do we get and what is relatively cheap for Apple historically speaking. And if I get to that sort of conclusion, I might or might not buy Apple, or I might sell put options on Apple, or I might do something else, or I might do nothing and continue searching. Either way, it's good to have your tabs on the companies that you're interested in. Apple was just one example. I would analyze any company this way before I start investing in them, and it starts telling me a story. Are they overpriced? Are they underpriced? Their debt to equity is high. Well, that's because they're buying back their shares. That's where the cash goes. So no wonder their equity is diminishing, because they're buying back the shares. So this debt to equity does not scare me. Some people would say debt to equity has to be low. Companies should not have a lot of debt. True, but if you're buying back your own shares, this debt to equity ratio becomes meaningless. So now all of a sudden I learned something. I don't have to calculate this ratio for Apple. I don't have to follow this ratio for Apple, because I know they're buying back their stock. That adds to my understanding of company significantly. If you were to filter for companies with low debt, you might miss Apple. So that's another learning potentially. If you're filtering the stock market in hopes to find some good opportunities, well, do not filter by low debt to equity, because you will miss some of these high-performing stocks and companies that are buying back their shares. So either way, lots of conversation could start based on these findings. And I do appreciate your time. Thank you for watching this video. I'm going to continue making some others. If you'd like to analyze any particular company, if you're curious on my take on it, put the comments, smash that like button, subscribe, and let's make some money together. Thanks so much. Have a wonderful